Hello and welcome to Money Matters TV. I'm your host, Doug Hepburn of Hepburn Financial Advisors, a boutique wealth management firm located in Phoenixville, Pennsylvania. Trusted advice to successful individuals, families, and businesses for over 20 years. I'd like to welcome my guest host, Robin Bond of Transition Strategies. Robin is an employment lawyer representing executives in employment, severance, and contract negotiation matters. She is a former in-house attorney and author of the book, How to Negotiate a Killer Job Offer, whose foreword is written by Mark Cuban. Welcome to Money Matters TV. Robin, how you doing?
I'm pleased to be with you today, Doug.
Yeah, glad you could join us today. I know there's been some wild stuff in your world, in particular with the Federal Trade Commission releasing some regulations on non-solicitation, non-compete agreements. Can you tell us a little bit about that?
Sure. Well, a non-competition agreement is a form of restraint of trade. We've had them for years to allegedly protect a business's legitimate investment in employees, and this covenant keeps employees from quitting or actually being fired and then going to work for a competitor and using that knowledge for the benefit of someone else. So the federal government has been looking at this issue for a long time, saying, are these things really fair? Is it really helping or hurting the economy by keeping people from working? And this is the first time the federal government has ever looked at non-competes, because non-competes throughout history have been a state issue. There's 50 states, 50 different rules on non-compete agreements. So this was the very first time a federal agency has looked at sort of putting an umbrella over this type of an antitrust restraint on trade and regulating it at the federal level. Of course,
Wow.
they had public hearings, they got input from businesses and individuals, and then came out with a sweeping decision that except for senior level executives, non-competes would not be enforced. And this was supposed to take effect August 24th. But of course, as we are all seeing, no matter what kind of a decision comes down in court, someone's always appealing it. So the Chamber of Commerce has appealed it. And an accounting firm, I believe, in Texas, Ryan LLC. So they have appealed this. So now the sweeping ban on non-competes is not taking effect, but the matter is on appeal in the federal court systems.
Wow. Yeah, it seems like really broad regulatory overreach from the federal perspective, and it's got to be that has to have Silicon Valley up in arms. Not to mention professional services firms.
Yeah. Well, part of my work is dealing with executives and helping them navigate moving from one job to the next in light of non-compete issues. And, I will tell you, if these things are written in an overly broad way or a way that keeps an employee from working, I don't think that's right. I think they need to be drafted as narrowly as possible to protect an employer's legitimate business interests. But if I tell you, hey, Doug, if you quit my firm, you can't work anywhere in financial services for a year, but I'm not paying you any severance, how would you like that, right?
Yeah.
It's not what you would consider conducive to keeping people working and paying taxes and supporting their families. So it has to be a balance, protecting an employer's legitimate business interests, but not so sweeping as to keep you from earning a living.
No, I couldn't agree with you more. I mean, there has to be some sort of balance. I can imagine that, obviously employers, drafting these agreements want to make them as broad as possible, but you gotta keep your employees' interests in mind as well, because they're not slaves.
Well, if anybody has signed one of these, I can tell you, I negotiate people out of them all the time. It is possible to negotiate out of something that you've signed. So don't feel that you're a prisoner or you're totally stuck or you have no choice but just to go out there and violate the non-compete. Because, trust me, it takes some money to fight your way out of it. But if you have to go to court and defend, it can cost you $50,000. So, I mean, that's big money. You're off to try to work it out than to, just take a chance and go into court.
And, it's not just executives that are facing these. My daughter actually took a position with a very large consulting firm, probably the largest in the world. And as she was signing her paperwork, she asked for a copy, and a manager said, "Well, you don't need that." None of the other people asked for a copy of their non-disclosure agreement, their NDA or non-compete agreement, and she was the only one who asked. So I think when you're, and this is a relatively entry-level position, or maybe one with 1 or 2 years experience.
So why does an entry-level person need a non-compete? Does the entry-level person really pose a competitive threat to the employer's business? I mean, you'd have to look at, there's a lot of tests. Did you get good consideration to sign it?
Right.
Is it reasonable in scope and duration?
Right.
Is it the least restrictive necessary to protect a legitimate business interest? And there's a lot of ways you can attack these or punch holes in them. And in Pennsylvania, our laws are, if you were a poor performer, and it's difficult for an employer to enforce a non-compete, because where's the competitive threat?
Right.
You weren't a good performer, So again, the state law balancing thing has been good. I think there's about 17 states now, and I don't know all of them, that don't enforce non-competes at all. Pennsylvania does, New Jersey does, Delaware does, New York does, all the states around us.
Right.
But I don't know whether the FTC's rule will make it through the court systems, because it's the first time there's been a federal oversight of this. And historically, the courts have not found there's a need for federal oversight over true state issues. The question will become, is this truly a state issue, or is commerce so interstate now that maybe it should be regulated federally? I can tell you from my practice, commerce is very interstate. It's not just limited to one state. Everything is, this state, that state, headquarters here, but you're working here and the offices are there. And it's very, and that doesn't even take into account the international scope of things.
Well, we'll keep an eye on this and certainly circle back with you as developments transpire. In the meantime, we have a viewer question on the subject of employment law from Grant Miller of Philadelphia, who asks, when does overtime pay begin?
Okay. Well, federal overtime provisions are contained in the Federal Fair Labor Standards Act. And under that act, employees must receive overtime pay for hours worked in excess of 40 in a work week. A work week is defined as 7 24-hour days. So if you work more than 40 hours in a work week, then you have to be paid time and a half, which is 1.5 times your regular rate of pay. Now, I think Grant is the person asking. I can't see the name.
Yep. Grant Miller.
Okay, but there are a lot of exceptions to whether you're entitled to overtime pay or not. Not everybody is entitled to it. Certainly not management level people are not entitled to it. So you need to check that and see if you're entitled. But if you are considered a non-exempt, meaning you get overtime.
Right.
It's hours in excess of 40 in a work week.
Great. Well, thanks, Grant. Thanks for that answer, Robin. And thank you, Grant, for sending that in. If there's something that you'd like us to answer on Money Matters TV, here's how you can get your question submitted.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
With the recent rise in interest rates over the past couple of years, there have been a number of downstream effects on the economy, from the construction industry to such as housing, commercial office space, on down to the federal budget with interest payments on the debt. But one area that we haven't addressed is the impact on businesses. And to help us understand more about the lending market in this space, we're joined by Dana Crouse, Regional Vice President with Northwest Bank. Welcome to Money Matters TV, Dana.
Hi, Doug. Hi, Robin.
Hi, Dana.
Dana, tell us a little bit about yourself and what you do at Northwest Bank in the C&I space, as it's known.
Sure. So my position with Northwest Bank, Regional Vice President, Commercial Relationship Manager, C&I Lending. My role with the bank, I work with businesses from $5 million in revenue size on up. Industry focuses that we work with: manufacturing, distributors, service businesses, engineer firms, professionals, some specific industries. A few verticals that our bank works in would be, our commercial lending space. We have SBA lending, commercial real estate, franchise, healthcare, sports finance.
Interesting.
Dana, everybody's looking for work that's meaningful or purposeful. What is it about this line of work that's meaningful to you?
I would say that building the relationship with the customer, going out, working with them to come up with solutions on how to, expand their business, work on specific projects, equipment, and then going out at the end and seeing the full project come together.
So supposing you come across a prospective customer that's looking for financing, what are they going to need to provide in order to get a commercial loan?
Typically, a customer would have to provide 3 years of business tax returns, CPA prepared financial statements, 3 years of personal tax returns, personal financial statement, a debt schedule, interim balance sheet and P&L, AR, AP aging, inventory reports, and I guess it would be basically geared toward what type of loan they were getting. If they were buying equipment, we would want to see, invoice, things like that.
This is an interesting thing. Like, we talk about tax returns, and sometimes the experience is if you don't need the money, banks are standing in line, sending you flyers, please, we want to give you money. Okay. But if you need money, it's sort of like, we don't want to give it to you. And so help us understand, like, the whole idea of personal tax returns or people having to individually back the business loans.
Like personal guarantee. Yeah.
So typically a bank likes to have the personal guarantee that the borrower, that the CEO, president of the company is willing to back the loan personally along with the business. But, if a guarantor is looking to have a business loan without the personal guarantee, it would all be based upon the strength of the cash flow, the credit worthiness, things like that. They're all a one-off basis. So we can't really say in particularly how each deal would work, but a bank would entertain it.
So is that how the bank looks at cash flow as part of a C&I loan?
Yes, absolutely.
Yeah. Okay.
So in regards to the cash flow, we look at debt service coverage ratio.
Okay, that's helpful.
That makes sense. You got to be able to pay your
coverage ratio.
Right. And that makes sense because you got to be able to service the debt. I know certainly with individuals as opposed to businesses. Most banks will look at a debt service of maybe 30% of income as your max. And I'm not sure what your ratios are. I'm sure they vary from bank to bank. But when it comes to working capital, there are a lot of companies where their cash flow may vary throughout the year, either because they're getting over 50% of their revenue in the last quarter of their fiscal year, or they have expenses that oftentimes are bunched up in certain periods of the year. How do you underwrite for and qualify a customer for working capital?
So when we look at working capital, we take a look at accounts receivable and inventory. Typically, the bank would look at 80% of the accounts receivable within 90 days of the date of invoice to issue a line of credit. Inventory, the banks typically advance 50% of the inventory of a specific report.
Well, if I want to buy equipment, like I know a lot of law firms have to invest in technology and technology related equipment, what options do clients have when they have to purchase equipment?
So with equipment, there's a lot of different options. Standard equipment loans typically have a 60-month term. We also look at equipment revolvers or lines of credit where the business can base those CapEx needs annually and borrow off of an equipment line. There's SBA 504 and 7A loans that they can purchase equipment on. Those are some to speak of.
Before we leave that, what does a revolver mean?
It's a revolving line of credit. So it's a line, essentially an equipment line of credit that's put into place so that the customer can purchase equipment throughout the year. And not have to put a new application every time he's looking to purchase that piece of equipment.
So it's almost like working capital, but it's secured by the equipment?
Yes.
Or is it just
assets,
specifically for equipment purchases? I'm sorry?
It would be secured with the business assets along with the UCC filings of the equipment.
Interesting. So, when people think about collateral, obviously, we just talked about using the equipment on a equipment line of credit as collateral for the loan. What other types of collateral are banks looking at, in particular Northwest, for C&I loans? And can you tell us a little bit about C&I and what that stands for?
So C&I stands for commercial and industrial loans.
Okay.
They're typically a loan that a business or corporation takes out. They typically have a personal guarantor.
Right.
And your other question was based on collateral.
Right. So generally, before we move on, so you're really talking about like manufacturing concerns as opposed to real estate, right?
What was your question, Doug?
So with commercial and industrial, you're talking about manufacturing concerns more so than real estate entities. Is that correct?
Well, owner-occupied real estate would be considered commercial and industrial.
Okay.
So if a borrower has like a 50% or greater occupancy in the business, that's considered owner-occupied real estate.
Okay.
Somewhere where the business is going to be operating out of.
And Dana, you mentioned SBA loans too, a short while back there. Tell us a little bit about SBA loans and what's the benefit to using them? Under what circumstances would you use them or not use them?
So SBA loans, a lot of people may know them or think of them to be small business loans, but they're not always used for small business financing projects. There's a wide variety of different types of loans, but two that a lot are used of are SBA 7A and the 504. If you have a borrower that would not want to go conventional or doesn't have enough cash to put 20% in for conventional financing, then you could typically look to SBA, where they would only have a 10% cash injection versus 20 for conventional. If you were looking if there's like collateral shortfall, we would possibly look to SBA. There's a lot of different options there.
How do those, I'm sorry, I didn't mean to interrupt you. I was going to ask you how those loan rates, how do SBA loan rates compare to, other commercially available loan rates?
So the SBA 504 is a mix of a loan with the bank and a local CDC, and those blended rates are very competitive. An SBA 7A loan is a higher interest rate loan, but those loans are backed where there's typically a collateral shortfall.
Okay. That's helpful to know. Thank you.
Yeah. That's on the subject of SBA loans. I know we had a previous conversation where you mentioned that these can actually be valuable tools in business succession planning. So, for instance, if a business owner wants to transfer the business, sell the business to existing management or a buyer, it sounds like using an SBA loan could be an option there, but certainly you've got things that you need to comply with, right?
Yeah. So I think every structure and deal is looked at differently. When customers have like a shorter amount of cash, a lesser amount of cash, we'll definitely look to do the SBA. Sometimes people will want to have loans for a longer term. So you could buy equipment instead of having a 60-month term on equipment. We could look to do an SBA equipment loan possibly for 120 months.
Oh, wow. It's a long time.
So would these be considered, I know we talked a little bit about the business succession, but even for expansion, would you
Absolutely.
use an SBA loan for that?
Yes, you can.
Okay. And I guess in order to get the loan, you'd have to have a pretty good business plan, to be able to show what your return on investment is going to be for the expansion plan. Is that correct?
Absolutely. Along with business projections for the few years and details around, the whole project.
So it's not necessarily funded through existing cash flow. There's an expectation that, by borrowing this money and investing it, it's going to make more, and therefore future cash flows from business expansion is going to fund the repayment of the debt.
We're going to look at existing cash flow and future cash flow.
Okay.
On a business expansion, they're going to do a 3-year, of previous tax returns, what the business cash flow looks like on the new proposed debt. And then they would also look at projections possibly for 2 years. I think every loan size is different.
Right.
It would really be based upon what that specific project looked like.
And sometimes too, Dana, this not only expanding, but I represent a lot of executive clients. Some of them decide they want to leave the corporate world and buy a business. Can you help people get a loan to buy a business, or how could you structure that?
Absolutely. Business acquisition loans are something that we see often. I actually just worked to get an approval for a business that had worked as an office manager within the organization for 14 years and structured an agreement of sale with the current business owner to purchase the business for $1,350,000. Typically, a borrower the bank would look to use an SBA 7A loan structure for business acquisition. The borrower and buyer would look to put 10% down on the project. SBA would offer 90% financing. There's a lot that goes into it. I think every company's different, but when you're financing goodwill, in an acquisition. In that scenario, the 7A is great. You can also put real estate, equipment, FF&E.
That's helpful.
Fantastic. No, that's really interesting. You know, so far we've been talking about companies looking at getting new loans, but one of the issues that we've come across on this program is that you've got a lot of debt out there that was issued at much lower interest rates, and companies are having to go and refinance it, whether it's multifamily properties, stuff that's backed by real estate, commercial office space, and of course, in this situation, commercial and industrial businesses and properties. What is the refinance market like right now, and how are people going about refinancing some of this debt that's maturing?
So refinance is a huge topic of conversation, especially for clients that have, variable rate loans that are a high interest rate right now. Maturing mortgages, customers are always needing refinances on those. Refinances is all based on the cash flow and the credit worthiness of the customer. If they're attached to real estate, we'll look at the equity in the real estate appraisal. We do look at debt refinances outside of real estate. We can look at equipment refinances. The SBA has a refinance option with the SBA 7A to consolidate multiple types of debt onto one loan. And then a new product that we are using is an SBA 504 refinance, which can allow borrowers to refinance, like an SBA 7A loan that has an 11%, 11.25% interest rate in our current market and is impacting, the cash flow of the business. The SBA 504 would look at the original use of the loan. If there's real estate, FF&E in that the 504 project can refinance. They can also take out eligible business expense, which is technically equity in the project, to use towards other eligible business expenses, such as payrolls,
Right.
different things like that.
You know what? This has been fantastic. A wealth of information for our viewers. I really want to thank you for coming on the program, Dana, and sharing such great information with our viewers. I want to thank you, Robin, as my guest host for today. You did a great job, and be sure to tune in to our next show with Eric Parnell, CFA of Great Valley Advisors. And most importantly, we want to thank you, our viewers, for tuning in to Money Matters TV, where your money matters.